Thanks, and good to hear the air conditioning is coming on. I don't think we really wanted to play a game of strip poker this early in the day. Great to see everyone here. It's been, I think, since November 2019 since we kind of all got together in Toronto. So really great turnout and really appreciate the support from everyone. In case you're new or you've forgotten who I am because you haven't heard me talk at you for 2+ years, Patrick Wood. I formerly was in the valuation sector of self-storage for about 6 years, and as Mike Burnham told me when I told him I made the move, I've now moved to the dark side into brokerage, taking the knowledge from valuation and have moved over to helping people buy and sell storage. So Sue was chatting with me when she was putting the conference together and wondered what can we give kind of as a value add to a lot of the new members that came in during the pandemic. And a lot of those members were single or 2-unit operators rather than the large groups that we also have here, which is great to have, but we really try to help out as many small members as possible. So if you're at the large operators conference last night, this next talk probably isn't for you. And you're actually probably going to be a little upset with some of the advice I give the small operators if you're looking to buy. So apologies in advance, but we're here to educate everyone. So before I get into helping valuations in your storage facility, just wanted to kind of talk about the storage market in general and what we're seeing. It's sort of what I always used to do, more in depth. I wrote an article in the Canadian Self-Storage magazine in January talking about where we'd seen the storage market and where we thought it was going. At that point, I did say the crystal ball was a little cloudy, and I did flag that one of the major things that could cause issues in the market would be interest rate increases. And it seems like the Bank of Canada read that and went, okay, let's make sure that that comes true. From when we started in January to now, I think we've had 3 increases. Word is we're getting another increase in July, all because of inflation. So that does impact the storage market, but in many different ways. Valuations haven't taken a real hit yet. We expect cap rates to move because of interest rates. We're not seeing it just yet. But what's nice in storage, unlike multifamily or industrial where you have long-term leases, is all of you guys can raise your rates tomorrow if you want. So in an inflationary environment, we're probably one of the best suited industries to cope with that. Don't be afraid to raise your rates. If you're seeing your expenses go up, make sure you're at least keeping pace with that. So for now, I just want to get into how smaller operators can look to increase their value, either for selling or if they're looking to refinance, pulling some cash out, or just increasing the amount of money they put into their pockets at the end of the day. Part of this is going to be taken almost from a case study of a facility that we transacted late last year. That facility was put under contract by someone in 2020 at about $8 million. We came in after that deal fell apart, worked with the owners for almost a year to get them ready to sell their facility, and then we transacted it for them at $11.25 million. A couple dollars more than what they would have got. Yes, the market did increase between there, but not by that amount. So I just kind of wanted to run through what smaller operators could do to help increase their bottom line in day-to-day operations, for sales, for refinance, or just to make sure that you're getting the most you can out of your facilities. First thing I think everyone should really look at, and there's a lot of great vendors downstairs who do this, is some type of computer management system. I know everyone thinks that, everyone's on SiteLink or Storable or web self-storage. I can assure you, after scanning 327 individual file folders in a facility, not everyone is online or in a computer. Don't just install the system, use it. We had a situation where we spent months getting a facility into SiteLink, setting up all their rent, setting up their facility, setting up everything, turned it over to the owners. The owners were like, well, we're selling it in a month. We won't use it. It's fine. Very difficult for the new owners who took over after that. So use it. The tools there are amazing. And as some owners I've talked to said, it's great. You can use SiteLink from your phone on the beach when the weather's really terrible. So not only does it make it easier, it allows you to not be at your facility all the time. And it gives you really great revenue tracking so you can work on pushing your rates up. That's the next thing. We see a lot of people who are like, I'm 100% occupied. This is great. But your rates are also 40% below your competitors. You should always be surveying, who and what is doing, what the rates are doing. If there's a brand new Class A facility and you're a Class B drive-up, chances are you're not going to attain their rates. But if everyone's a Class B drive-up facility and you're $40 a unit less, you're leaving money on the table. It's okay to have a bit of vacancy. You always want new people coming in off the street. As a CEO of a large storage company who I will not name, I don't see them in the room, told me I never want to not have a unit for the guy who just got kicked out by his wife on Friday afternoon at 5 o'clock, because that guy will pay anything. Again, I don't see him in the room, so I think we're safe. But, that's, although a little predatory, that is the thought. You always want to be able to bring new people off the street at higher rates. Always look to grow your rates. That's why we're in this business. The next thing, and this is tough for small operators, and I get that, stop taking cash. Stop putting it in your pockets. I know it sucks to pay the Trudeau government all the taxes, but I assure you that $50,000 a year you're putting in your pocket tax-free probably has $1 million to $1.5 million impact on your value, your facility, if you go to sell it. And it's really difficult to go to a buyer and go, hey, listen, I know that it's not on the books, but trust me, it's there. Because really, they're not going to trust you. I know it's tough in the short term, but in the long term, it really will pay off. When you sell the business, when you refinance the business, or in case a CRA comes and wants to look at your books, because they're pretty good at what they do. After that, it'd be really useful if you're looking to sell your business to probably stop paying all of your personal and family bills out of the company. I looked at a facility once in my appraisal career that had something on the order of $83,000 in auto expense every year. The facility was 28,000 feet. Very nice cars, though, parked out front. It's one of those things where, yes, you need a vehicle. Yes, it's great to not have to pay for your entire family cell phone bill out of your pocket. But when it comes to appraisal or when it comes to sale, those things will come back and bite you because people are going, well, your expenses are off. We're going to go with your actual expenses, not a stabilized number. Or the stabilized number they're willing to go with isn't as low as it should be. Next, fix the visible issues in your facility. If you have gutters that have been taken off by a novice U-Haul driver, which happens significantly more than most people know because 5-ton cube vans are a lot larger than they expect, fix the gutters. Chances are you have the culprit on camera driving into your building. Follow up, get it paid for, get it fixed. Little things like that might seem minuscule and, it's only $500. But in an appraisal, in a sale, or even with people touring your facility who want to rent from you, it's those little intangible things that people can't put their finger on that allow you to charge higher rents or allow you to get a better appraisal or allow you to get a better sale price. I can't tell you how many times in my appraisal career I walked through facilities and went home to make sure my tetanus shot was up to date, and I took a really long hot shower because they were pretty terrible. A lot of those facilities, thankfully, have been knocked down and redeveloped, but those facilities probably have the potential to generate the same revenue as some of the nicer facilities with just a little bit of work. If you want to maximize the value of your facility, do the little bit of work. It's not tough. The next thing is, especially for sale and appraisal, try to mitigate and remove any environmental questions or issues you might have on your property. I toured a facility once that had enough paint to probably repaint half of Vancouver, sitting in a pile next to a locker that had been emptied a year earlier, and then down the road there were some oil drums. That's a red flag for anyone. I would wonder, do we have contamination issues? And anyone here who has tried to purchase a facility as of late, probably know environmental has become a very big thing in the last, I'd say 10 years, but 5 years definitely. And without having a clean facility, there's a chance that you're not even going to be able to get financing. On that note too, if you have delinquent units that are clearly never coming back, remove them. Get their stuff out, get the unit re-rented. That same facility that had the paint and oil and some boats and some other stuff that should have been dealt with also had 4 or 5 units that were more than 5 years delinquent. they're not coming back. And if they do, they'll probably understand their stuff's gone. We do run into situations, and I'm sure some of the larger operators can speak to this, where people die without a will, or their storage locker wasn't mentioned in their will, and family doesn't even know it's there. And if you just leave the stuff for 5 years, that's a non-revenue unit. You haven't collected the rent. You're never going to collect the rent. The stuff inside there, the dirty mattresses, the old newspapers, the china that no one wants to buy anymore, isn't going to be worth what you're owed. So as much as it's difficult, do the work, take the stuff out, auction it, call Wayne 100 drunk, whatever you got to do, get that unit back in service, because every month you don't, you're losing money. The other things that we think are very good to do if you're going to get a sale is to get an appraisal. Talk to an appraisal professional. Go through the process, because at least that way you have an understanding of where you're going to be. Having been a former appraiser, or an appraiser in recovery, as I like to say it, appraisals should be conservative. They should be below probably what you're going to get in the open market, because honestly, appraisers don't want to get sued. That should give you a good basis. I had a conversation with an owner this past week that was thinking about selling or not. And I just kind of went through his numbers with him, and he thought his facility was worth around $10 million, and it's probably worth $8 million. But we resulted in him probably calling an appraiser on Monday and getting an appraisal done. Because that way he either knows that he should get $10 million and I was wrong, or it is probably worth $8 million and the appraiser will tell him $7.5 million and he won't sell. But at least he has a professional opinion then. Additionally, if you're borrowing money, you're going to need an appraisal. Always use an appraiser who actually knows self-storage. I can't tell you how many owners have given me appraisals from their local guy who did their apartment buildings. And you read through it, and the comparables used in it are light industrial, vacant land, boat storage, and self-storage is a very specialized asset. That's why we're all in this room. If self-storage was light industrial, none of us would be here. Lease it for 5 years, go away, come back, lease it for another 5 years. So those are kind of the first things you really want to look at. The next thing is to figure out what your plan is. Are you in this for a year, 5 years, 10 years? Are your kids going to inherit this? Because it's important to plan for those things. I remember when I used to do feasibility work, I'd always ask the owners, are you going to keep this? Or are you planning to build it, lease it, and sell it? Because there's little things you can do that make it cheaper to operate in the long run. If you're going to keep it, it costs a little more to build. Or if you're just going to sell it, don't bother. Address the lighting situation. We've lost most of the incentives for LEDs, all that kind of stuff. BC Hydro thinks we've all converted. I assure you we haven't. I've seen your facilities. Trust me, go the LED route, put the motion sensors in, do all the right stuff. It will save you money. It will save you headaches. You won't get the call saying the lights in building B are burnt out on Christmas Eve. Those little things might not seem like much, but either in a capitalized value or on a 10-year term, saving that $1,000 a year in hydro really does matter. Put the time in actually reinforcing your buildings. I've been in a lot of new Class A facilities, I think some of the owners are in here, who've put the time in to put the diamond plate on the corners, to reinforce the bases of all their units. And 2 and 3 years down the road, they don't have dented in walls. They don't have carts that look like they've been ridden down the stairs 4 or 5 times. And all those little things save you money in the long run. It also makes your customers feel better. The next thing too, be very good on your security. The last thing you want is to be known as that facility that always gets broken into. I was talking to an owner in Alberta of a facility I had appraised maybe 5 years ago, and they're talking about their neighbor down the street who I had also appraised about 4 years ago, and how that facility just keeps getting broken into, and they always cut the fence and just walk in, and it happens every 2 or 3 months, and started wondering if this owner was the one actually doing it. But be that as it may, that facility had been quietly for sale for 2 years, and no one could make a go of it because its occupancy was low and it had a bad reputation. Don't have a bad reputation. Spend the extra little bit, put the cameras in, put the security systems in, do that little bit of work to make your facility as good as it can be, because that's going to help you, and it will help when you want to sell, refinance, or just not have to answer an alarm call at 3 a.m. when it's snowing outside. So that's sort of my basic overview. The next thing I will say is always consult professionals. I said appraisals. You should consult a professional if you're going to try to sell, if you're going to try to buy. It's a little bit of an infomercial because that's what I do. But at the same time, we have seen the differences in facility values. Like I said, that one facility was under contract for $8 million. It then sold for $11.25. If anyone here would like to give away that much money, I will send you my banking details. Feel free to wire it on over, and then you will never have to hear from me again. It's important to make sure you have a competitive process if you're going to sell. Consult realtors in your local area. We're BC, but if you're Alberta, Saskatchewan, Ontario, there are great self-storage people in your communities. And that's what they do. A residential realtor probably shouldn't be selling a small self-storage facility, just like I should not be selling a house. It's not what I do. And actually in our office, when we get Western Investor and we go through and we see a residential realtor selling self-storage or something they shouldn't, we kind of get excited. We figure we can probably make a deal. So in the interest of time, I want to flip this over to questions now. It's usually my favorite part, Q&A. There's a few people in here who like to play Stump Patrick. Fire away. I think you have microphones in front if you don't want to yell.
When you do an evaluation on a facility, will you ever give tips on how to increase the valuation? Like let's say it's an unpaved facility. Would you be able to provide insight as to if it was paved, your valuation would go from X to Y? Is that something that can be included within the scope of evaluation?
So first of all, no longer do appraisal. Really want to toss that out there. I hate writing reports, so. But yes, in a sense, you cannot quantify a value of what a paved versus unpaved facility will be. But you can look at your competitors and say, well, this one's paved, they're getting this for rent, and their occupancy is this. This one's not paved, so on and so forth. It is really important in like paved versus unpaved to really look at the market and make sure, we have some markets on the island, for instance, where nothing's paved. And in fact, one of the markets, you're not allowed to pave it just because of drainage issues. So there's really not a big point in being the only guy out of 20 guys who's paved their lot if everyone else is gravel. Paving's not cheap, in certain parts of the world. You only have certain windows you can pave. But yeah, on a wider scope picture than that, I always used to be like, hey, you have a lot of economic vacancy where you're not charging proper rates to the people in the facilities. Get those rates up to market, and then your market rates are low too. Get those up. So yes, you can talk to an appraiser or a broker about different ways to increase the value, and we've done that, and part of that facility that discussed is that's what we did. We went in and said, hey, these rates probably 15% below market. Can you raise them 5% in July? We'll raise them again in December, and then the new owner can raise them again in March. Because you're going to get X amount from this raise, Y from this, and Z from that. It's very useful to talk to a professional about things like that too, because they can sort of give you the path on where you'll end up if you do these things. Oh, come on. Don't be shy. I know it's been 2.5 years, but someone's got to have something.
Where do you see cap rates going in primary and secondary markets?
Assuming the Bank of Canada is honest with what they've said they're going to do, up. The cost of capital is only increasing right now. I think July is going to be a 0.5 point. Maybe they'll take the summer off. Probably not. They're bureaucrats. They have said they're going to move the overnight funds rate from where it is at, I think, 1.5 today to 3%, probably by the end of the year. No bank is going to hold the rates you're seeing today with another 1.5 increase. So cost of capital goes up, which means it costs more to pay for the deal, which means either you increase your down payment so your debt service ratio is covered, or the price comes down. I do think we're going to enter into a little bit of a situation in the next 3 to 6 months where owners aren't willing to agree their values have gone down and buyers aren't willing to agree the values have stayed the same. And there's going to be some friction until we kind of all figure out that there's been a change.
I have a question. Oh, sorry.
Go for it.
If with the current market, with the rates being as they are you finding a difference in the types of buyers who are attracted to storage at this time?
So it depends. It's always my answer, I know. Your major center, Class A, 20 to $80 million facilities, same buyers. Same group, access to major institutional capital or public money. Those haven't changed. In the smaller transactions, we're still seeing a lot of multifamily people deciding that a 2.5 cap for multifamily in Vancouver is insane when they can't raise their rates, so they're going to venture into another asset class. Storage has been in the news, good or bad. Everyone thinks we're the hot new thing. So yeah, we're getting a lot more inquiries on listings and things from first-time investors. A lot of the guys who've been in this for 10, 15 years think the cap rates and the values we're paying today are insane. I've heard that a lot. Well, I used to buy things at a 7. Well, not today. So we're not seeing as much from the people in the industry. A lot of new players, a lot of new money from the sidelines right now.
Just a quick reminder, can everyone use their little microphones? Because it's being recorded and your question won't get recorded. And you just press that square button under your microphone to talk. Thank you.
Patrick, could you, right, there we go. Is that better?
Yep.
Could you tell me a little bit more about Vancouver Island market and how it differs from the mainland and in terms of saturation? Like, is there still space on the island market?
Yeah, so Vancouver Island's interesting. It's kind of its own world. We like to think that the ferry keeps a lot of the riffraff out. No offense to Vancouver people, but it's nice to be able to go back home. Our cap rates there have actually been pretty aggressive. We sold 4 facilities in the last year on the island. All of them sub or right around a 5 cap rate, which as a former appraiser, I had trouble wrapping my head around, but as a broker, was very happy to see that from my clients. So the Vancouver Island market, Vancouver Island's growing incredibly quickly. The CRD, which is the Capital Regional District, which is our 13 municipalities. Yes, we have 13 different municipalities on the South Island. It's growing somewhere around 2 to 2.1% a year. It's increased since the census as well. So there's a lot of demand for storage there, but there's also a lot of new storage that's come to the West Shore market. So Western Communities is View Royal, Langford, Colwood, Soup, Machosen, and there's more coming. Whereas the downtown core, Victoria, parts of Saanich, Oak Bay, Esquimalt, we haven't had storage built since 2008, and there's a very big lack of it right now. There is a new facility slowly underway. So saturation-wise in the South Island, it's pretty saturated, but honestly, finding land would be harder than leasing up a facility in a saturated market right now. As you move up island, Nanaimo is growing incredibly rapidly as well. A lot of new construction in the south area for storage and multifamily, but there are pockets. If you can find I-5 zone land between the Malahat and Duncan and build a facility on it, and there isn't any, I looked, you would lease it up in probably a year. As you go further north, we have Parksville, which is, I think, an anomaly in Canada that has a supply somewhere in the order of 15 square feet per capita. It's pretty wild. It's also all pretty full. I think, Rob, you can probably nod with me on that. And I'm sure you don't understand why either.
Yeah, it's a strange market. It's pretty shocking to see how much new supply has gone into there over the years. There was a bit of stabilization moments, but it is quite full right now. Thus, we're busy working on expansion. But yeah, it's a bit of an anomaly. It's very strange.
Yeah. And then as you move further up island into Courtney, Comox. Because we have the Air Force Base for the West Coast in Comox, Comox is a very hot storage market. A lot of people coming in and out. We're getting apparently a new squadron there. And then when we eventually buy new planes to replace the legacy Hornets that are older than I am, we're going to get a squadron there as well, apparently. So that market is probably one in 5 to 10 years that's going to boom even more. And then as you go further to Campbell River, yeah, there's probably demand up in Campbell River as well because the population there keeps growing. But it's really area and site specific in a lot of places on the island because we've built so much. And that really goes for the rest of the Lower Mainland as well. There's been an incredible amount of self-storage development in the Lower Mainland all the way out to Chilliwack in the last 5 to 7 years that not all of it's even online yet. I mean, if you look sort of over in the Boundary Burnaby corridor, we have a bunch of new players opening massive Class A facilities with a few more in the ground and on the way. I think we're running into the situation in Vancouver like we already have in Toronto, which is where you need storage, you can't build it, and where you can build it, you don't need it. So it's very important to talk to professionals about feasibility work. I personally don't dabble in that anymore. I mean, I look at clients' projects and kind of go, you probably shouldn't build there. But if you want something that is bankable, take to the bank, go through, consult a storage professional on that. Because not only is it supply and demand, but now with the price of construction, I've looked at some markets where it needs storage. You have to build probably 50, 60,000 feet in this market, but the rates are $15 a square foot a year, so you'll never get a return on building the project because the rates are too low in the market. And until the rates catch up, it's not financially feasible to build a project. Yes, you can fill it, but everyone else in the community hasn't raised their rates. So, anyone else?
So I know that the BC market has been strong. How about the Alberta market?
Yeah, so what we see in Alberta is there is strength in that market now. I mean, I don't know how many Alberta people we have in here, but I really appreciate you guys are the eternal optimists on the economy because it always does pay off. It's cyclical. There are bad times, but there are really good times. I think I saw WTI crude was $1.23 this morning, which means Western Canadian Select's probably 105. At those prices, everyone in Alberta is making money, and everyone's happy. So the Alberta market hasn't seen the cap rate compression that we've seen in BC because no one but people in Alberta are willing to invest in Alberta when things are bad. I mean, that's the whole reason Canadian Western Bank exists, is they couldn't fund anything during one of the economic downturns. So a bunch of Albertans got together and made a bank so they don't have to go to the big banks. So yeah, Alberta, I think there's a lot of opportunity in that market right now. Cap rates are noticeably higher than what we're seeing in BC, and the competition for properties is less. Having said that, you do have to pick your markets properly. Fort McMurray is probably always going to be a problem from here on out. I would not advise anyone to build in Fort McMurray ever. Stephen, you're welcome. Just want to make sure those stay not full, but as full as they can. Fort McMurray just didn't get residents back after the fires. So you had the downturn and then the fires, and I think the last stat I saw was something like 8,000 residents just didn't come back. They didn't rebuild their houses, they just took the insurance money and left. So there's markets you don't want to be in, but a lot of the smaller centers, there's a lot of opportunity, there's growth all over. And there's some owners in here, I think, who, if you're looking to buy, would love to chat because they've been doing it for a while and would love to retire. So happy to introduce you to them.
Hi, thanks, Patrick. I represent one of the institutional buyers, and I agree with absolutely everything that you said in your presentation. I would add, maybe make one add-on point, in that when we're looking at purchasing a facility, it's far more important for us to see that you're at or above market rate, and that's including your discounting, than your occupancy rate, because we're confident in how we're going to manage a facility. So I would recommend everybody for maybe 6 months or a year prior to preparing your business to sell, look at what the market rate is and be at or above that, and really limit the discounting that you're doing. And that way you can maximize the value when it comes time to sell.
Yeah, and to add on to that, a lot of the mom and pop operators, I have the pleasure of sitting in the offices with them, petting their dogs as we're chatting about them selling, and a lot of the problems you run into is, well, that's Jim, and well, you know, his wife was having some medical issues, so I didn't want to raise his rents. And, oh, well, Bob, he had to close his company down, so I didn't feel right raising his rents, and I get that, and it's definitely a personal thing, and you have to decide as an owner how important that relationship is to you and what it's worth to you on a value. Because honestly, that $50 a month will translate into a lot more money capitalized when you look at it on a yearly thing. But if for you it's more important to keep that relationship, by all means do it. But understand that the new owner probably isn't going to. So, all right, anyone else? Oh, at the back. There we go.
As more and more cities are considering placing a moratorium on the development of new storage facilities, can you talk a little bit about how you see that would affect the value of existing facilities?
Yeah, definitely. I mean, Vancouver's been in the news lately with a policy that I feel is a little short-sighted. I get where it's coming from. They have made numerous sins in the past rezoning industrial land into multifamily in areas they never should have. And they're trying to make up for that now by not allowing any more industrial land to be rezoned and to restrict what goes in. I mean, the False Creek Flats master plan for years has had prohibited use. Self-storage is, I think, the third line. Marcus, you can probably, if it's not the third, it was the second or the fourth. And now recently they've been talking about banning it from transit centers and a bunch of other things. I think they might have actually done it. I'll be honest, I wasn't paying that close of attention. And what I do think it's going to continue to stabilize the values in an increasing cap rate world. You may see those values not fall as cap rates rise because there's less supply. I did a little survey yesterday when I was taking a break from a drive from the interior. And in all of Canada, there are 5 or 6 storage facilities actively listed, period. So, you know, supply is already tight, and with not allowing construction on new stuff, it's going to get tighter. The other thing that may actually prevent self-storage construction in the downtown core is construction prices. I think even more so than what you're going to see from the city. Land prices and construction prices together mean that right now to sell a self-storage facility at a profit margin you probably think is appropriate, it's going to have to sell for more than anyone's willing to pay. And I've run into that recently. So yeah, it will help values, but I think more than anything, it will provide a stabilizing aspect. I don't think it's going to push them up, at least in the near term, because I do feel that in the near term, near to mid-term values may fall a little bit. All right, last call. Anyone? All right, I'm going to turn this back over to Sue. Thank you.